Now, what happens if, let's take that middle scenario where they put a couple of $100 a month on top of what you're already paying. So maybe you're paying, I don't know, $1,500 a month, okay? And then your payment goes up to $1,800 a month to catch up again.
Right.
And what happens if the extra $300 a month is something that you're just really struggling to do right now because you had to go through all your finances during this whole pandemic time and you just don't have that money? Rather than fall behind continually more and risk going into foreclosure, talk about, is there an option to do what you mentioned, refinance? Tell us about that.
Yeah, so
or cash refi.
A cash out refi, yeah. I mean, there are options. I mean, one, you may get with the current servicer and renegotiate the payment terms if you can. They may decide to do a modification to extend it out instead of a 30-year. They may extend it out to 40. Finding ways to work with you so that you can stay in that current loan and make the payments. I mean, they're going to find ways to work with you because they don't want you going into foreclosure, and they definitely don't want to impact you negatively and have a loan that goes somewhere else to another servicing company because of a refinance. But in the event that they're not, then a refinance definitely can be a benefit. So there's two obviously refinances that are out there. One is just a traditional rate and term refinance, where we would just reduce the loan term, reduce the interest rate on the existing loan term. So if you're sitting at a 30-year loan and you're sitting at 4% or 4.25%, then we may be able to refinance the loan down to say 3.125, and get that payment lower for you back down to that $1,500 mark. Now there are some people right now that we are doing cash out refinances for, and what we're looking to do there is taking the current loan balance and increasing the loan balance to pull out cash. Now we can only increase it to what is 80% of the value of the home. So just again, simple math, $100,000, the max loan amount you could have is $80,000. So if you had a $60,000 loan, then you could pull out $20,000 to get us to 80, which would be 80% of that $100,000, right? So we're able to pull out up to 80%. Then from there, what we're doing is we're paying off credit cards. We're paying off installment loans. We're paying off loans that have higher interest rates and typically higher payments on those cards and installment loans to help bring down the delta in what would be an increase in mortgage payment, right? So overall, it'd be a net savings to what is their outgoing cash flow. So we're definitely doing that. And
use that cash to make their mortgage payment, right? So that they don't fall behind?
Yeah, 100%. They can use it to make their mortgage payment. They can use it to pay off other high interest rate credit cards or installment loans with higher payments to just really net bring down their cash flow, to a more positive position for their family, right? That's what we're really looking for is how can we put them in a better cash flow position?
Mm-hmm. Okay. What about qualifying for that? I mean, do you have to have like your credit score, is there like debt to income ratios and things like that? Like when you traditionally qualify or go to get qualified for a home loan, are you looking at those same things again for a refi, or are they different for those people that are already in their mortgage?
Yeah, great question, Christine. They're going to be pretty similar. I mean, we're having to document one's ability to repay the loan. I mean, we're the one now, like if we're gonna refinance the loan, we're taking on this new loan. Right. So we have to be responsible with the type of loan that we're going to put out there because, I mean, for instance, if we know a loan is in forbearance, it's going to be very difficult for us, almost impossible, to refinance that loan because it's in forbearance. We're not going to take that risk on another loan that ultimately is going to be in forbearance again. Right? Because that just means we're either going to have to service a loan in forbearance and pay out the investors, but not take in any cash, or we're going to know if that client says, hey, we're going to file for forbearance when you do this loan for us, then we know that when we sell that loan off, let's say that the ultimate end servicer is going to push that loan back to us and tell us that we're going to have to buy that loan back. And that's going to be, a significant cash outlay to my parent company, Benchmark Mortgage. And we're not going to take that as originators. We don't want to set our companies up to take that risk. So we have to ask good questions. We have to make sure that we're being responsible loan officers and prudent for our company and for that client. So it's still going to be the same type of loan. We're still going to ask the same kind of questions. We're still going to have to look at debt to income ratios. We're still going to look at, their income and their asset positions. But the delta difference is we're not going to have any down payments. They can definitely do it without any out-of-pocket expense because we can roll in the cost to refinance into the loan. So I'm doing refinances every day, and these individuals are coming out of pocket typically with no money at closing. And then if we do the cash out refinance, we're just obviously pulling it out of the cash that we're giving them. So they're still getting cash at closing.
Okay. So it sounds like what you're trying to tell everybody out there is rather than take the forbearance right now, take a look at your financial situation and determine if you're going to be able to make your payments or not based on your current situation. And if you think that you're not going to be able to make them, then right now is the time to get with your lender, call your lender, and then tell them, hey, look, I may need to refi or do a cash out refi prior to going into that or taking that forbearance option that the CARES Act has.
Yeah, absolutely. I mean, I would, if you can avoid the Forbearance CARES Act option, I definitely say avoid it because you're again, it's not a freebie. You're going to have to pay those payments back. And so if there's a way to do that, then, it's important to talk to your loan officer, talk to me to figure out, is there a better strategy to get you into a place that makes more financial sense on a monthly basis that doesn't end up putting you in a negative position 3, 4, 5, 6 months down the road. But again, as lenders, as loan officers, we got to be asking the right questions, being responsible for the loans that we're making now so that, we're setting them up correctly and then we're also protecting our companies.